If you're a first-time home buyer thinking of using an FHA mortgage for your home purchase, I hope you're listening. I'm going to share why an FHA loan may not be the right loan for you. Brand the Mortgage Man here, and I've helped more than 10,000 home buyers over my 20-plus year career, putting me in the top 1% of loan originators nationwide. And I always make it a point to educate my clients on their home financing options. In this video, I'm going to share my reasons why an FHA loan may not be the right choice for all first-time home buyers. I'll discuss what FHA mortgages are, who's eligible for them, additional costs involved with FHA mortgages, loan amount limitations, low down payment alternatives, and I'll even show you some comparisons between an FHA and a conventional mortgage to show how your credit score can determine which makes more sense for you. So let's get into it. So first off, what are FHA mortgages? Now, you may be thinking to yourself that it's a first-time homebuyer mortgage and that FHA means something about first-time homebuyers, but that's not the case. FHA stands for Federal Housing Administration, and FHA mortgages are insured by the government, by the Department of Housing and Urban Development, HUD, and they're used specifically for the purchase of a primary residence. And contrary to popular belief, they are not only for first-time home buyers. But who's eligible for an FHA mortgage? Well, that's a good question. An FHA mortgage is available to anyone buying a home that they plan to occupy year-round, which is what a primary residence is. It's a property you're actually going to live in, so it's not an investment property, it's not a vacation home. You actually have to occupy the property year-round, but like I said, you do not have to be a first-time home buyer. As a matter of fact, you can own another home right now. As long as you're moving out of the home you own and into this new property that you're going to finance with an FHA mortgage, you can get an FHA mortgage on that property. Now, although FHA mortgages allow for low down payments, as low as 3.5%, and if it's a property that's actually owned by HUD, as low as $100, which is crazy, there are additional costs that come with FHA mortgages. And one of these is called your upfront mortgage insurance premium. Now, an upfront mortgage insurance premium is something that gets rolled into the loan, and it's equal to 1.75% of whatever you're borrowing. And this applies to all FHA mortgages. It's not the lender charging you this, it's the Department of Housing and Urban Development. It's a fee that they add on to FHA mortgages that most borrowers choose to roll into the loan, because in most cases, although you can pay this out of pocket as part of your closing costs, most borrowers that are going with an FHA mortgage are doing so because it allows for less money out of pocket. So why would you pay the 1.75% out of pocket? That's only going to increase what you need for the purchase. So most of the time, I would say 99.9% of the time, the buyer who's getting an FHA mortgage will roll that mortgage insurance premium into their new loan amount. So technically, you're actually borrowing more than 96.5% of your purchase price. And where I got 96.5% from is the 3.5% down payment subtracted from 100%, right? So 100 minus 3.5 leaves 96.5. But you're rolling up the upfront mortgage insurance premium into your loan amount, so it's technically more than 96.5% of the purchase price. On top of that, you have monthly mortgage insurance, right? So on conventional mortgages, you have something called PMI, private mortgage insurance. On FHA loans, same concept. You have monthly mortgage insurance, which is mortgage insurance that's paid as part of your monthly payment. Now, there are loan amount limitations, really on any loan, but even more so on FHA. So depending on the county and where you're looking to purchase your property, there's going to be a maximum loan amount you can borrow. And that's going to be lower on an FHA mortgage than it would on a conventional or a VA mortgage. For example, conventional and VA mortgage loan limits right now, late 2024, are $803,500. However, there are some counties where the FHA loan limit is $498,000. Think about how big of a difference that is. That means you can maybe buy something for $517,000, putting down 3.5% to get to that loan limit. Versus conventional, assuming you qualify, you can buy something for the mid 800s, 830, and put down 3% if you're a first-time home buyer, and qualify for a conventional loan at $803,500. So there are loan amount limitations. So if you're looking for something in the higher price points, on a single family, by the way, this is strictly a 1-unit property I'm talking about. The limits increase if you're going to a 2-unit or a 3-unit or 4-unit property. But strictly speaking about a single unit, a 1-unit property where it's a house, a townhome, you're gonna live in it, it's gonna be limited. Now, there are low down payment alternatives. I briefly mentioned you can do a 3% down conventional mortgage if you're a first-time home buyer. There is also actually a 0% down conventional mortgage right now. There are going to be limitations on your income to qualify for that program, right? You can't make more than 80% of the area median income where you're looking to purchase, but there is a 0% down option. If you're a first-time home buyer, as I was starting to get into, you can put as low as 3% down. And a first-time home buyer in the eyes of a mortgage company or a lender mean that you have not owned a home within the last 3 years, so the last 36 months. So it's okay if you owned a home, it just couldn't have been within the last 3 years. If you haven't owned a home in the last 3 years, you're considered a first-time home buyer for lending purposes, and you can put as low as 3% down on a conventional mortgage. If you have owned a home in the last 3 years, and you have income that's 80% or less of the area median income, you can still put 3% down. Other than that, you'd have to put 5% down if you currently own a home or have owned a home in the last 3 years, or you're over 80% of the area median income. But 5% is not much more than the 3.5% down payment allowed by FHA. There's also Home Ready and Home Possible, which are Fannie Mae and Freddie Mac's low down payment alternatives to FHA financing, and those actually have reduced mortgage insurance as well. So something to keep in mind with these, aside from the fact that you can have a low down payment, they also don't have that upfront mortgage insurance premium that comes along with FHA mortgages, which means you'd actually owe less on the property even if you put the same 3.5% down. So keep that in mind. Now, let's talk about FHA versus conventional, right? So we're going to compare an FHA mortgage to a conventional mortgage for two different borrowers. Now, each borrower in this scenario has the same exact income, which falls within 100% of the area median income for the city they're buying a home in. And the reason I mentioned the 100% area median income in their first-time buyers is because when your income is at or below 100% of the area median income for where you're looking to buy, and you're getting a conventional mortgage and you're a first-time home buyer, your interest rate is not going to change depending on your credit score. You get the same interest rate whether you have a 780 credit score or you have a 630 credit score on a conventional loan. So that's important to keep in mind. So we're using that for this scenario. These borrowers also have the same amount of funds available for the purchase, but one borrower has a 640 credit score, which would be considered to be on the lower end of things when it comes to qualifying for mortgage, while the other borrower has a 780 credit score, which is the top tier for a mortgage credit score. So let's see how the numbers look. We're going to base this on a purchase price of $400,000. So let's talk about borrower one. Borrower one has a credit score of 780. So let's look at the FHA option first for this borrower. They're going to put 3.5% down. The interest rate they qualify for today is 5.75%. They're going to have an upfront mortgage insurance premium, right? I mentioned that you have the upfront mortgage insurance premium, which is 1.75% of the loan amount, of $6,755. Their monthly mortgage insurance, I also mentioned that, MMI, is $176.12. Their monthly payment, principal, interest, and mortgage insurance alone, right? Because that's all we're comparing for this purpose. The taxes and the insurance, and if there's an HOA fee, will be the same, whether you get an FHA mortgage or a conventional mortgage. So for comparison's sake, we're looking at principal, interest, and mortgage insurance. That would be $2,468.13 per month. Now, we want to compare this to a conventional mortgage with 3% down. So putting 3% down, the interest rate this person would qualify for is 5.999%. The mortgage insurance would be cheaper. It would be only $97, and there's no upfront mortgage insurance premium, right? The monthly principal, interest, and mortgage insurance payment would be $2,423.01, which is lower than the FHA option. So in this scenario, the conventional loan makes more sense since it saves money up front with a reduced down payment, saves money with a reduced payment, and saves money when it's time to sell since the loan balance will be lower due to the lack of upfront mortgage insurance. But let's see if the results are the same for the borrower with a 640 credit score. So borrower profile 2 is a borrower with a credit score of 640. As I mentioned, that's on the lower end of the spectrum for qualifying for a mortgage. So FHA, same down payment, 3.5%. The interest rate for this borrower would be about 0.5% higher, 6.25%. The upfront mortgage insurance is going to be the same, $6,755. The monthly mortgage insurance, keep this in mind, this is very, very important. The monthly mortgage insurance is still going to be identical at $176.14, even though it's a lower credit score. The monthly principal, interest, and mortgage insurance payment would be $2,594.40, higher than the first borrower's, but he had a better credit score, so he had a lower interest rate. Everything else was the same. Let's compare this to the conventional option with the 640 credit score. So, say this person's putting 3% down. Their interest rate they qualify for would be 6.125%. So actually lower than the FHA interest rate, but higher than what the conventional borrower gets with the higher credit score. Mortgage insurance. Now, I told you to pay attention. This is important. Mortgage insurance is impacted by credit score on a conventional loan. the mortgage insurance would be $459.13 per month. The monthly principal interest and mortgage insurance payment in this scenario would be $2,816.66, much higher than the FHA option. So in this scenario, although the rate's lower, the FHA loan makes more sense since it will save money on a monthly basis due to the lower cost of mortgage insurance. Since the cost of mortgage insurance and FHA loans is the same regardless of credit score versus a conventional loan where it varies substantially, the payment is much lower on the FHA loan. You need to remember, there's no one-size-fits-all mortgage program. It's important to discuss all options with your lender to determine which makes the most sense for your scenario. If you find this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages. And make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.